Welcome to Illuminati Silver. We tell you the truth about silver. Today is Friday the 16th of August 2019, and we're going to chat about a subject much covered since the 14th of August, the inverted yield curve. We discuss what it is, what it potentially means for the economy, why stock markets fell on its announcement, and what it could mean for gold and silver prices. Let's investigate. The inverted yield curve sounds like a complex technical economic term which only city insiders and serious economists could possibly understand. Well, that's perhaps what they would like you to think and believe. But surprisingly, it's actually one of the simpler and easier to recognize economic calculations. It would be true to say, however, that its impact and predictive qualities require a little more analysis and understanding. We're going to give you a few definitions here of what an inverted yield curve is, all of which basically means the same thing. An inverted yield curve occurs when long-term yields fall below short-term yields. An inverted yield curve is an interest rate environment in which long-term debt instruments have a lower yield than short-term debt instruments of the same credit quality. An inverted yield curve marks a point on a chart where short-term investments in US Treasury bonds, for example, pay more than long-term ones. Normally, someone who lends to the government or a corporation for, say, 1 year, by buying a 1-year government or corporate bond, would expect to get a lower interest rate than someone who lent for 5 or 10 years, making the yield curve upward sloping. That is, the longer the time period, the higher the rate. When short-term rates are higher than long-term rates, that slope, rather than going up, goes down, and therefore it is inverted. So let's take one step back. What is a yield curve? The yield curve is a plot of interest rates for government bonds of all maturities in a given country. It is essentially a graph showing the relationship between interest rates earned on lending money for different durations or time periods. Now, under normal circumstances, if you were to lend money, as banks do, you are likely to charge a lower rate of interest if you are lending over a short term compared with lending over a longer term. Let's explain why. Let's suppose I were to lend you $10,000 for 12 months. I take into account the following factors. 1, the likelihood, of course, of you being able to pay me back. 2, what interest I could have got on that money elsewhere during that 12-month period. 3, what other investments I am not able to take advantage of while you have my $10,000. And 4, what treat I could have bought myself with that $10,000, which I now have to delay because you have my money. So, because it's a relatively short period of time and the risk is moderate to low, I will charge you, say, 6% for the money, which is cheaper than a credit card, but much more than I'm getting from a bank. Now, let's say you wanted to borrow that $10,000 for 5 years as opposed to 1 year. Now, I still have to take into account the factors mentioned previously, but my costs and risk have now increased. I risk the fact, of course, you may disappear with my money and you have more time to do it. I risk the fact you may die and there is no one I can claim from. I risk the fact that over 5 years, your circumstances and financial situation could deteriorate, and you won't be in a position to pay me back. I risk the fact that the dollar could devalue in that time, so my money will purchase less. I risk the fact that interest rates could rise during that period, and I could have earned more of my money than I am earning today. And I also have to suffer a prolonged period of not being able to use that money for either other forms of investment opportunity or to buy, say, that Rolex watch I've always wanted, which in 5 years could cost considerably more than it does now. So taking these factors into account, I'm now going to charge you 10% interest per annum rather than 6% to compensate me for the above. So this is why generally longer-term rates are higher than short-term rates charged by banks and governments. When an inverted yield curve is created, all of this is turned on its head. You're now being charged more short-term than you are long-term. Now I can hear you ask, so what? Why does this matter? Well, think about it. What does this actually signify? What does it tell us? Well, in simple terms, it's basically saying that interest rates are likely to fall in the future. It signifies that inflation is likely to be lower in the future. Otherwise, rates will be higher. It signifies that if I want to borrow short-term, I have to pay more. So as a business, what is your response likely to be? The answer is, put off any borrowing until those rates fall. Put off any investment until inflation falls and costs are lower. Put off any immediate borrowing, as it will be cheaper to borrow and invest later on. It is for this reason that generally, when there is a yield curve inversion, it normally predicts a looming recession because borrowing and investment is delayed and demand for goods reduce, and thereby the economy slows down. Now, this is a simple explanation. It is a little more detailed than this, as there is quite extensive financial modelling behind these conclusions, but I'm sure you get the point. So going back to last Wednesday, the 14th of August, the yield on the 2-year US Treasury note had risen above that on the 10-year US Treasury note. The yield on the benchmark 10-year Treasury note was 1.623%, which was below the 2-year yield at 1.634%. Now, it may appear as a very small percentage, but when you're talking about billions, if not trillions of dollars, it makes a difference. Now, just as a quick aside, a US Treasury note is an intermediate-term interest-bearing bond issued by the US Treasury. It's a marketable US government debt security with a fixed interest rate and a maturity between 1 and 10 years. In simple terms, they're bonds government issues to receive capital, and the interest rate is the rate it has to pay for that capital. These bonds are then either held until maturity or sold in what is called the secondary market. The last inversion of this part of the yield curve, and this is why it was so significant on Wednesday, was back in December 2005, 2 years before a recession was brought on by the financial crisis. According to Credit Suisse, a recession occurs, on average, 22 months following such an inversion. You see, the Federal Reserve and other central banks have consistently referred to the fear of deflationary pressures as the biggest worry facing financial markets. Wednesday's bond markets tell us that inflation is going to be much lower in 2029, 10 years from now, than it is in 2019. This is one of the key interpretations of an inverted yield curve. Inflation expectations for future periods are lower, and that can only mean a slowing and perhaps contracting global economy. This is why the major headlines in the news and newspapers emphasize the fact that an inverted yield curve is a classic signal of a looming recession. The US curve has inverted before each recession in the past 50 years. When short-term yields climb above longer-dated ones, it signals short-term borrowing costs are more expensive than longer-term loan costs. So as already mentioned, under these circumstances, companies often find it more expensive to fund their operations, and executives tend to restrict or completely shelve investments. Consumer borrowing costs also rise, and consumer spending, which accounts for more than 2/3 of US economic activity, slows down. The economy eventually contracts and unemployment rises. The general consensus amongst seasoned investors is that when the yield curve inverts, one should sell their stocks and shares, as their value is based on growth, and the major equities such as the likes of Amazon, Facebook, Apple, etc. have all been built on rapid rates of growth in revenues and earnings, and expectations. If the bond market is telling us the global economy is slowing, the stock market should price in lower rates of growth for individual stocks. This is why shares of those major companies in particular, and the vast majority of stocks around the globe, fell sharply on Wednesday. In fact, the Dow fell by 800 points, and some traders were expressing the experience as carnage. Now, it did recover almost 100 points yesterday, but this fear factor is unlikely to go away. Added to this, we have to be mindful that the global economy in 2019 is based on access to credit, and it has been for the past 50 years. If credit conditions dry up because they become more expensive, we could easily see a meltdown in 2019 as we did in 2008-2009. The reason this is a distinct possibility, and why we have been somewhat critical of Trump's tariffs, is China. China's economy was barely dented by the financial crisis that affected Western economies in 2008-09. But today, it is just as dependent on credit as that of the US, and in fact more so by certain measures. In 2008, the total assets of the Chinese financial system were $9.1 trillion. That compared to $12.2 trillion in the US financial system assets. As of June 30th, 2018, some almost 10 years later, and is the latest data currently available to the public, Chinese financial system assets totaled $39 trillion. 39 trillion. Over 4 times as much, dwarfing the US total of $17.5 trillion. Now that may come as a surprise. According to financial journalist and Forbes contributor Jim Collins, quote, "That's why pictures of protesters occupying the airport in Hong Kong are so scary. That's why the Chinese government's decision to let the yuan-dollar exchange rate rise above 7-1, making Chinese financial assets worth less in dollar terms, is so scary. That's why President Trump's trade tweets can and will move the markets significantly in either direction. Anything that makes Chinese companies less likely to repay their loans is a decided negative for global bond markets. Each of those 3 factors certainly qualifies. That's also why the yield curve in the US has inverted. Any measure of US current economic activity or financial system liquidity looks fine, or even better than fine. But the bond market looks like the world is in the middle of a global catastrophe. Why? Because global markets are interlinked." Unquote. So, it is highly likely, therefore, that the bond market and its inverted yield curve are telling us that economic growth is slowing, or perhaps even contracting. The valuation of stocks, above all else, depends on estimates for rates of earnings growth. With this in mind, it is little wonder that seasoned investors have been selling stocks. We all know from past experience that when funds leave the stock market and fear sets in, often we see at least a proportion of those monies head into safe haven assets such as gold and occasionally silver, when gold becomes increasingly expensive. It also tends to have a negative impact on the US dollar value, at least short term, which also increases the price of gold and silver. This we saw on Wednesday, when gold jumped from $1,495 to $1,522, and silver from $16.88 to $17.37, though they are currently standing at $15.12 and $17.16 respectively. Now, before you rush out and fill your safes and homes with gold and silver, as it appears that we are saying that a recession is about to begin, we also have to add that there is another side to this coin, and that it's not all negative stocks as would first appear. Whilst it is true that weak economic data and low inflation around the world, trade conflicts and political tension in places such as Hong Kong have sparked worries about global growth, fueling market expectations of central bank interest rate cuts and triggering steep falls in government bond yields, and that the US curve has inverted before every recession in the past 50 years, offering a false signal just once in that time. Despite all of that, not every fund or portfolio manager is convinced that a recession is imminent. Remember, we mentioned earlier that Credit Suisse stated that a recession occurs within 22 months on average, after a yield curve inversion. Some investors believe that the US economy is actually stronger than many fear, and that the immediate future is nowhere near as bleak as many pundits are making it out to be. Capital Economics have stated, for example, quote, "Inverted yield curves in the US and elsewhere tell us very little about the timing of future downturns, and for now at least, the economic data are more consistent with a slowdown than a downturn in the world economy." Unquote. We saw yesterday, for example, a large amount of economic data being published, as we highlighted in our weekly update on Sunday. Retail sales for July were up 0.7% against an expectation of 0.3%. Productivity from quarter 2 was up 2.3% against expectations of 1.7%. And retail sales excluding automobiles were up 1% in July compared with expectations of just a 0.5% rise. These figures are not terrible and not indicative of an imminent recession. MUFG Managing Director and Chief Economist Chris Rupke has commented, quote, "This is not what a recession looks like. We know, we checked it. The rule of thumb for recession is 3 consecutive months of declining retail sales." Unquote. And BMO Chief Investment Strategist Brian Belsky said on CNBC's Fast Money Halftime Report, quote, "The yield curve matters when it inverts over a several-week, if several-month time period. We had an intraday inversion. In 1998, we had a 27-day inversion. Just because everyone thinks we're going to have a recession doesn't mean we're going to have one. Saying we're going to have a recession is saying the sun is going to come up tomorrow, Of course we're going to have a recession at some point, unquote. Now, UBS said in a note to clients, and we think it's worth quoting it here in full. Quote, bond yields signal recession risk. We say not so fast. Unlike trade conflicts, an inverted yield curve by itself has limited economic impact. Instead, its signal about the health of the economy is what matters. And it is not as negative as some investors fear. For one, there has been a long and variable lag between initial inversion and the start of recessions, 22 months on average, ranging from 10 to 36 months for the last 5 recessions. In addition, Treasury yields are being weighed down by the almost $16 trillion in sovereign bonds globally with a negative yield, distorting their signal about US economic activity. And finally, the length of time the yield curve is inverted and how much is inverted matter. If Fed rate cuts successfully steepen the curve comfortably into positive territory, this brief curve inversion may be a premature recession signal. Unquote. So what are we all to think? There is no doubt that an inverted yield curve has occurred. Traditionally, it has led to a recession, but generally it's been many months and in some cases a couple of years before it has happened. We all know there is a US presidential election in 2020. And you can bet the current administration is going to do all that it can to make sure the economy is humming, or at least not declining. This is partly why President Trump has delayed many of the proposed increases in China tariffs until December. And we should not be too surprised if he starts making more positive overtures to China for the reasons we stated earlier. From our own modelling, which of course does not have the immediate up-to-date detailed data that the government statisticians have access to, suggests that if a recession does occur, it's more likely to happen in 2021, not 2019 or even 2020. Whether we like it or not, modern monetary theory, or more money printing, will continue to put off that inevitable day of reckoning. And whilst we may see deteriorating economic figures or less robust growth, we could find ourselves in another multiple-year period of above-marginal growth whilst the liquidity permeates throughout the economy and the world. In terms of gold and silver, we may see some pullbacks, but can be moderately confident that their prices are relatively underpinned with a short-term median outlook for lower interest rates ahead, and the pressure on the Fed to continue reducing them. The future, however, is, to a large extent, determined, at least short-term, on the actions that President Trump now takes, and to what extent he manages to reduce the disruption caused via his Twitter feed. What happened on Wednesday is a reminder to all those who have responsibility for economic policy that actions have consequences and they have to be carefully thought out and implemented deliberately, as there are black swans circling and the numbers are increasing. What do you think? Do share your views. We hope you have found this video interesting and informative, and if so, please give it a thumbs up and share it on social media. Please ensure that you have subscribed to our channel and press the bell sign so that you are notified of any future videos. Also, kindly visit our website at illuminatisilver.com, and if you haven't already done so, please subscribe either as a free or paying member for regular email updates and offers. Disclaimer: Illuminati Silver owners come from a background of banking, international wealth management and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice, and merely represent the personal views of its owners.